Welcome to Quantum Finance. My name is Parker. I am the head trader here, but I am not a financial advisor, and this is not financial advice. So today I wanted to make a breakdown video of the squeeze. I know we talk about it in most of the market recaps, pretty much all my trades. We use the squeeze, so I wanted to make a in-depth guide into actually what it is, how it works. And so, when you guys are making these trades basing it off these squeezes, you actually know like the fundamentals behind it, the actual what's happening under the hood and like why it makes sense. So, we'll start down here with this indicator that we use to identify squeezes. We have the TTM squeeze indicator. And as you can see, when the circles do turn red, that is the indication that a squeeze is currently happening. And these waves here are just a momentum oscillator that is overlaid on top of the squeeze indicator. Just a heads up, this is going to be an extremely technical video. And just a quick note, the market is currently actually squeezing right now, so it might be kind of cool to see something happen while we're doing this video. So, what is a squeeze? First of all, we need to turn on some studies so we can really see what's going on here. So we're going to turn on a 20 exponential moving average. We are going to turn on some Keltner channels. And we are going to turn on some Bollinger Bands. So here we have it. This is basically the technicals that go into making a squeeze. So starting in the middle, we have the 20 exponential moving average. And what this is just a representation of the average price over 20 periods, over 20 candles, right? And then in the green here, we have Keltner channels. And what the Keltner channels are is a representation of the average true range going out to a factor of, I'm pretty sure on Thinkorswim, it's 1.5 from the 20 EMA. So what you can view these Keltner channels are is just like an average price channel, right? This is the average true range from this 20 EMA for a factor of 1.5. And then we have the Bollinger Bands. And the Bollinger Bands are standard deviations. Here we're using two standard deviations from the mean, which is the 20 EMA. So what is a squeeze, right? So a squeeze down here, as you can see, is when the Bollinger Bands go inside of the Keltner channels. So that's when the standard deviation comes within the mean, right? And so what that is that's your squeeze. So the second that Bollinger Band comes within the average price channel, within these Keltner channels, you get the red on the squeeze indicator, right? That is when a squeeze is happening. And so what this is just, I'd like to view it as you have to think about it in terms of statistics, right? So when the standard deviation is inside of the average price channel, within the mean, that is a volatility compression. That is a buildup of energy. When that happens, there's a higher statistical probability that there will be a volatility event in the market, right? And as you can see here, we had our squeeze, we had the volatility compression, which led to a volatility expansion, right? So the standard deviations could return out to the extreme. And in order for that to happen, the market has to make a larger move. So that is why in our trading videos, I like to go over and use these squeezes as the opportune entry point during the day, because technically and statistically, this is the highest probability that a large market move is about to occur in the price, right? So we can zoom out here because this is applicable on higher time frames. So we can look at, say, the 15-minute. Right, so here you have a squeeze on the 15-minute with upward momentum. You got this buildup of energy, this volatility compression, which led to this massive expansion to the upside in order for that standard deviation to extend, right, back to the outer extremes. We can also zoom out more. Let's say we can look at the 1 hour chart. And as you can see here, we have this squeeze with downward momentum. You can see this really tight squeeze here, which led to this volatility event, which caused the price to extend to the downside and for these Bollinger Bands to return outside of that Keltner channel. And so, yeah, the larger the time frame, typically the more powerful the squeeze is. Like here, for example, on the daily chart, right? We had this daily squeeze here with momentum to the upside. We got the expansion out. We got the volatility event, which did lead to upside in the market for multiple months. So, yeah, I hope this makes sense. Like, you guys understand what a squeeze actually is. So when I'm talking about it, when I'm like, you get your squeeze here, you know that you're getting a buildup of energy. You're getting a volatility compression in the data set itself, which will alert you that a event or a move is about to happen in the price itself. So yeah, as most of y'all know, I like to use the Bollinger Bands on my charts. And on some charts, I do like to use a 20 EMA, but I do not like these Keltner channels. To me, they just take up too much visual space, kind of clutter the data a little bit. So yeah, we take these off usually on most of our charts when doing analysis. If you've seen the Ultimate Charting Guide, you are aware of that. And yeah, so that's why we just use this TTM squeeze indicator down here. And it's nice because it does have this momentum indicator on here as well that we can use to cross-reference our trade ideas. So yeah, that should do it for the video. I hope this makes sense. You just have to view the squeeze as, you have to think of it in terms as statistics and data, and how squeezes are the highest probability chance to enter in a trade before a move occurs. Yeah, I know this was a super technical video. I hope it made sense. But yeah, appreciate y'all watching, and I will talk to y'all later.